$100 billion in assets in less than 2 years. That's how much capital BlackRock's Bitcoin ETF accumulated since launching in January 2024. Not a gradual institutional adoption. Over decades like gold ETFs, not a slow build like traditional commodity funds. $100 billion flowing into a single Bitcoin product in 21 months. This wasn't retail speculation. This wasn't crypto Twitter driving price action. This was the largest asset manager in the world, controlling $12.5 trillion, turning Bitcoin into infrastructure, into a product that generates recurring fees, creates institutional liquidity, and produces income streams for Wall Street's biggest players. These weren't Bitcoin maximalists buying the revolution. These were pension funds, endowments, insurance companies, and wealth managers buying exposure through the most trusted brand in asset management. Harvard's endowment holds $443 million in this single ETF. State pension funds allocated hundreds of millions more. And here's what makes this a turning point. BlackRock didn't just create the largest Bitcoin fund in history. They figured out how to turn a non-yielding, volatile digital asset into an income-producing machine. Options, strategies, covered calls, premium income products. The same playbook Wall Street used to monetize equities for a century, now applied to Bitcoin. At its peak, this single ETF generated $245 million in annual fees for BlackRock, more than their flagship S&P 500 ETF. Bitcoin became BlackRock's highest grossing revenue source in under 2 years. But systems don't transform into income machines overnight. People do. And to understand how BlackRock turned Bitcoin into a $100 billion asset, and what that means for everyone watching, we need to understand what this transformation meant to the people who had to decide whether to allocate billions to a digital asset most institutions had dismissed as speculation just years earlier. To illustrate this, let me tell you a story. Obviously a fictional one, but bear with me, because it's built from real allocation decisions, documented investment committee debates, and verified strategies happening at pension funds and endowments right now. Meet Michael Chen, 52 years old, chief investment officer of a state pension fund managing $18 billion. That money funds the retirements of 93,000 public employees, teachers, firefighters, police officers, sanitation workers, people who spent careers serving their communities and now depend on this fund to pay them what they were promised. For 28 years, Michael's job was straightforward: generate 7% annual returns to meet pension obligations while managing risk to preserve capital for the long term. Not exciting, not glamorous, but essential. His career had been built on one fundamental belief: stick to proven asset classes, stocks, bonds, real estate, infrastructure, maybe some commodities for diversification. The portfolio that had worked for pension funds for 50 years. The routine was methodical: early mornings reviewing overnight markets, investment committee meetings twice monthly, quarterly reports to the board of trustees, annual performance reviews with consultants, rebalancing allocations, managing external managers, monitoring risk exposures, coffee constantly, black, 2 sugars. Lunch, usually working through research reports from Wall Street analysts. Evenings catching up on reading, white papers, academic research, market commentary. The work was technical, but the responsibility was moral. Those 93,000 retirees depended on him. A 62-year-old retired teacher receiving $4,000 monthly. That payment came from returns Michael generated. If he failed, real people suffered. So Michael was conservative, appropriately conservative, not afraid of volatility. You need equity exposure to hit 7% returns, but careful about speculation. Thoughtful about new asset classes, rigorous about due diligence, which is why, when Bitcoin came up in investment committee meetings over the years, Michael's position had been clear. It's not for us, too volatile, no cash flows, no fundamental valuation framework, speculation, not investment. The committee agreed. Bitcoin wasn't in the policy portfolio, wasn't approved for allocation, wasn't even seriously discussed beyond occasional mentions in alternative investment reviews. Then, January 10th, 2024 happened. The SEC approved spot Bitcoin ETFs. And 3 days later, Michael's phone rang. It was the chairman of the investment committee. Michael, we need to talk about Bitcoin. Before we continue with Michael's story, do me a quick favor. Hit that subscribe button right now. This is going to be a deep dive into how institutions are actually allocating to Bitcoin, the strategies they're using to generate income, and what this means for the asset class going forward. You'll want to follow this channel for more content like this. And here's the thing. I want to know what you think about pension funds allocating to Bitcoin. Drop a comment right now, just one word: bullish. If you think institutional adoption validates Bitcoin as a legitimate asset class, or bearish, if you think fiduciaries are taking inappropriate risks. I'm genuinely curious what this audience thinks. Comment bullish or bearish right now before we get back to Michael's story. All right, back to that phone call. January 13th, 2024, Saturday morning. The chairman was direct. I've been getting calls from 3 board members. They're seeing news about BlackRock launching a Bitcoin ETF. They want to know why we're not participating. Can you prepare a memo for Monday's emergency session? Michael's first thought, emergency session? For Bitcoin? But he understood the politics. When BlackRock, the world's largest, most respected asset manager, launches a Bitcoin product, it sends a signal. If BlackRock thinks Bitcoin is institutional grade, maybe it is. Michael spent the weekend doing what he always did, research. He pulled up everything he could find. BlackRock's ETF prospectus, SEC approval documents, academic papers on Bitcoin's correlation to other assets, volatility studies, institutional adoption data, competitor analysis of the 11 Bitcoin ETFs that launched simultaneously on January 11th. The launch data was striking. Bitcoin had been trading around $46,000 when the ETFs went live. Trading volume exceeded $4 billion on day one. By end of the first week, BlackRock's IBIT had crossed $1 billion in assets. These weren't retail numbers. This was institutional flow. He called a consultant he'd worked with for years. Be straight with me. Is Bitcoin legitimate now, or is this just Wall Street chasing fees? The consultant was measured. Both. Wall Street definitely sees fee opportunity, but that doesn't make it illegitimate. Real institutions are allocating, not huge percentages, but meaningful amounts. The question isn't whether Bitcoin is real. The question is whether it serves a purpose in portfolios. Michael asked the key question, what purpose? 3 potential roles. 1, diversification, low correlation to stocks and bonds. 2, inflation hedge, fixed supply versus unlimited fiat printing. 3, volatility asset that can generate option income. Depends which role you care about. The third one made Michael pause. Option income. He understood that concept. His fund used covered call strategies on equity holdings to generate extra yield. Could you do that with Bitcoin? Monday morning, investment committee meeting, 8 people around the table. Michael presented his weekend research, factual, balanced, no recommendation yet, just information. A trustee asked the obvious question. Is this appropriate for a pension fund? These are teachers' retirements we're talking about. Michael nodded. That's the core question. Bitcoin is volatile. In 2022, it dropped from 69,000 to 16,000, over 70%. It could do that again. So the question isn't whether to put a quarter of our portfolio in Bitcoin. The question is whether a small allocation, say 1 to 2%, could potentially improve risk-adjusted returns. Another trustee, but Bitcoin doesn't pay dividends. How does it help us generate the 7% we need? That's actually what I want to research further. There are income strategies using options that might generate yield from Bitcoin's volatility, but I need more time to evaluate them. The chairman spoke up. Here's what I'm hearing from board members. We don't need to rush into this, but we need to be able to explain our reasoning. If Bitcoin becomes standard institutional allocation and we have zero exposure, we need to justify that to stakeholders. Michael, can you spend the next 60 days doing deep due diligence and come back with a recommendation? Michael agreed. 60 days, full analysis, recommendation with clear reasoning. He had no idea he was about to watch the fastest institutional adoption of an asset class in modern history. Week 1 of Michael's research coincided with week 1 of Bitcoin ETF trading. The volume was staggering. IBIT, BlackRock's product, was consistently among the most traded ETFs in the entire US market. Not just among new ETFs, among all ETFs. Michael watched the asset accumulation. $1 billion in week 1 became $5 billion in week 2. $10 billion by end of January when Bitcoin was trading around 42,000. He started making calls, peers at other pension funds, endowment managers he knew from conferences, insurance company CIOs. Everyone was having the same conversation. A pension fund CIO in the Midwest told him, we allocated 0.5% last week. Small enough that if it goes to 0, we can absorb it. Large enough that if it becomes a legitimate asset class, we're not completely absent. An endowment manager. Our investment committee approved up to 2%. We're starting with 1% and we'll evaluate over the next year. Michael noticed a pattern. Nobody was putting 10% of their portfolio in Bitcoin, but many were putting 1 to 2%. Small exploratory allocations that were large enough to matter if Bitcoin performed well, but small enough to manage if it did not. The math was straightforward. If Michael's fund allocated 1%, $180 million, and Bitcoin went to 0, the fund lost 1%. Painful, but not catastrophic. But if Bitcoin appreciated significantly over the next decade, that 1% allocation could meaningfully improve overall returns. But Michael kept coming back to the income question. His fund needed yield, 7% annually to meet obligations. Equities might give you 10% in a good year, but with volatility. Bonds were paying 4%. Real estate and infrastructure filled some of the gap. Where did Bitcoin fit? It didn't pay dividends or interest. So it was pure appreciation play, like gold. That concerned Michael because appreciation is uncertain. Income is more reliable. That's when he discovered the covered call strategies. Week 3 of his research. Michael was reviewing competitor Bitcoin ETFs when he noticed a fund called YBTC, Roundhill Bitcoin Covered Call Strategy ETF. The concept was immediately familiar. Michael's fund already used covered call overlays on equity positions. You hold the stock, sell call options against it, collect the premium, trade off some upside for consistent income. He pulled up YBTC's prospectus and distribution data. The fund was showing a distribution rate around 35%. Michael stared at that number. 35% from Bitcoin exposure. He understood the trade-off. You cap your upside. If Bitcoin rallied massively, you'd only capture gains up to your option strike price. Everything above that, you miss. But you collect the option premium regardless of Bitcoin's price movement. For a growth investor, that trade-off was terrible. But for an income-focused pension fund that needed 7% annually, it was potentially compelling. Michael ran scenarios. If the fund allocated 1% to a Bitcoin covered call strategy, generating 25 to 30% yields, that added 25 to 30 basis points to total fund returns. That was meaningful, enough to potentially close a meaningful portion of the gap between current returns and the 7% target. He called the consultant again. Talk to me about Bitcoin covered call strategies. Are they real or smoke and mirrors? They're real. Bitcoin's volatility is high. Typically 60 to 80% implied volatility compared to 15 to 20 for S&P 500. Higher volatility means higher option premiums. You can generate substantial income selling those premiums. The question is whether you're comfortable with capped upside. Michael was comfortable with capped upside. He wasn't trying to make speculative bets. He was trying to generate income for retirees. Week 5. Michael attended a financial industry conference where a panel discussed digital assets and institutional portfolios. One panelist was a portfolio manager from a large endowment. She explained their allocation. We have 2% in spot Bitcoin for long-term appreciation potential, and we have 1% in a covered call strategy for income generation. The income strategy gives us something like 28% yield, which is substantial. Yes, we're capping upside on that portion, but the income contribution to our total portfolio is significant. After the panel, Michael approached her. How do you think about the volatility risk? Bitcoin dropped 70% in 2022. She nodded. That's the key question. Our view, if you're holding spot Bitcoin, volatility is a bug. You're suffering through drawdowns hoping for eventual appreciation. But if you're running a covered call strategy, volatility is a feature. Higher volatility means higher option premiums means more income. We actually collected better income during the volatile periods. That reframed Michael's thinking. He'd been viewing Bitcoin volatility as a risk to manage. But for income strategies, volatility was the raw material that generated returns. Week 7. Michael was preparing his final memo for the investment committee. He'd spent 60 days doing rigorous analysis, read academic papers, interviewed peers, modeled portfolio impacts, stress-tested scenarios, consulted with the fund's legal team about fiduciary duty implications. His conclusion, a small Bitcoin allocation was defensible and potentially beneficial. The memo outlined 3 options. Option 1, no allocation. Maintain current policy of excluding Bitcoin. Justification, insufficient track record as institutional asset. Risk, if Bitcoin becomes standard allocation, fund underperforms peers. Option 2, small spot allocation. 1% in a Bitcoin ETF like IBIT for long-term appreciation. Justification, diversification, and potential inflation hedge. Risk, high volatility and potential for significant drawdowns. Option 3, income-focused allocation. 1% in a Bitcoin covered call strategy for yield generation. Justification, addresses fund's income needs, volatility becomes asset rather than liability. Risk, capped upside limits, appreciation potential. Michael's recommendation, option 3, 1% allocation to Bitcoin income strategy. Start small, evaluate performance over 12 months, potentially adjust. The investment committee meeting was scheduled for March 15, 2024. Michael presented his findings, 60 slides. Historical Bitcoin performance, correlation analysis, volatility studies, peer allocation data, income strategy mechanics, risk scenarios. The discussion was thoughtful. Some trustees were skeptical. Aren't we just chasing performance? Bitcoin ran up. Now everyone wants in? Michael addressed it directly. That's a valid concern. But look at the data. We're not proposing this because Bitcoin went up. We're proposing it because the income strategy addresses a specific portfolio need. We need 7% returns. Traditional sources aren't getting us there. This is a tactical allocation to an income-generating strategy that happens to use Bitcoin as the underlying asset. Another trustee. What about the teachers? How do we explain to them that we're putting their retirement money in Bitcoin? We explain it exactly as it is. We are allocating 1% $180 million out of $18 billion, to a covered call strategy that generates income. If Bitcoin goes to zero, we lose 1%. If it performs well, it helps us meet our obligations to those teachers. The risk-reward makes sense at this allocation size. The vote was close, but passed. 5 in favor, 3 against. Authorization to allocate up to 1% to Bitcoin income strategies. Michael spent the next week executing the allocation. By late March 2024, Bitcoin was trading around 70,000. Michael selected a Bitcoin covered call ETF that had launched recently and was showing consistent premium capture. $180 million position established over 3 days to minimize market impact. Then he waited to see how it would perform. April 2024, first month of returns. Bitcoin's price was relatively stable, trading between 65,000 and 70,000. But the covered call strategy generated 3.2% in premium income that month. Michael ran the annualized calculation. 3.2% monthly was over 38% annualized. Obviously, that rate wouldn't be consistent every month. It depended on volatility and Bitcoin's price movement. But it was a strong start. May and June brought continued premium capture. By end of Q2, the Bitcoin income allocation had generated about 8% absolute return, a combination of modest Bitcoin price appreciation and substantial option premium collection. Michael reported results to the investment committee quarterly. The trustees who'd been skeptical were warming up. "This is actually working better than I expected," one admitted. But Michael knew the real test hadn't come yet. The allocation had only experienced a benign market environment. Bitcoin had been relatively stable. How would the strategy perform in volatility? The months ahead would answer that question. Through summer and fall 2024, Bitcoin climbed steadily. By October, it had reached new all-time highs, briefly touching $126,000. Michael's allocation performed well, capturing premium income throughout the rally, though with capped upside as expected. The covered call strikes limited gains above certain levels, but the consistent income generation was exactly what the strategy promised. Then November 2025 brought the stress test. Bitcoin crashed from 126,000 in early October down to 95,000 by mid-November, a drop of over 24% in just weeks. The crash was driven by multiple factors: Federal Reserve hawkishness, concerns about AI stock valuations, and massive liquidations of leveraged positions. Michael watched the allocation closely. The Bitcoin exposure itself lost value, obviously, but the option premium collection spiked. Why? Because implied volatility exploded during the crash. Fear drives option prices higher. Higher option prices mean larger premiums to collect. The net result? The Bitcoin position lost about 16% during November. Bad, but not as bad as the 24% that spot Bitcoin lost. The premium income collection provided partial downside cushion. More importantly, the income kept flowing. Even during the crash, the strategy was generating distributable income. That income helped offset losses and provided cash flow that could be redeployed elsewhere in the portfolio. Michael attended the December investment committee meeting, prepared for tough questions. A trustee asked, "Bitcoin dropped over 20%. Should we exit this position?" Michael was ready. "Let me show you the full picture. Yes, Bitcoin dropped 24% from peak. Our position lost 16% because the premium income provided cushion. But look at what happened to our equity allocation. The S&P fell about 8% during October and November. Bitcoin wasn't an outlier in terms of volatility during a broader market correction," he continued. "And look at what happened to the income generation. We actually collected more premium in November than in most previous months. Because volatility spiked, option premium spiked, and we captured that. This is exactly how the strategy is supposed to work. Volatility becomes an income source, not just a risk." Another trustee. "But we're still down on the position since the peak. What's the path forward?" This is a 1% allocation intended as a tactical income source. It's performed well over the full period since inception. One volatile period doesn't change the thesis. In fact, it validated that the income generation works in both calm and volatile markets. Our job now is to continue monitoring and harvesting the premiums. The committee voted to maintain the position. No changes. By late December 2025, Bitcoin had stabilized around 97,000. The position had recovered some of its November losses, and the income generation continued. December saw strong premium capture as volatility remained elevated. Michael started receiving calls from peers again. Other CIOs wanting to know how his Bitcoin allocation had performed during the volatility. His answer was consistent. Better than expected. The income strategy did exactly what it was supposed to, generated yield during calm periods, generated even more yield during volatile periods, provided partial downside protection. It's working. One pension fund CIO told him, "We didn't allocate in 2024, now we're regretting it. The board is asking why we're not participating in what's becoming standard institutional practice." Michael understood. He'd been in that position 2 years earlier, except now he had performance data to show. Real results, not theory. January 2026 brought news that made Michael's strategy look prescient. BlackRock filed for a new Bitcoin Premium Income ETF on January 26th. The largest asset manager in the world was now launching a dedicated income product using covered call strategies. Michael read the filing carefully. The structure was exactly what he'd been using through other products. Hold Bitcoin exposure, systematically sell call options, distribute premium income. But BlackRock's scale and brand would bring massive assets to this strategy, which would deepen liquidity, tighten spreads, make execution more efficient. All benefits for existing allocators like Michael. He also noticed competitors announcing similar products. Fidelity was researching Bitcoin income strategies. Grayscale had filed for a premium income product months earlier. The entire industry was building these tools. That told Michael something important. This wasn't a fad. When every major issuer launches similar products, it means real institutional demand exists. Pension funds, endowments, insurance companies, they all needed income. Bitcoin volatility provided a source of income. The market was responding to that demand. Now, here's why Michael's story matters to you. It's a fictional character, yes, but every detail, the allocation process, the investment committee debates, the performance through volatility, the institutional adoption acceleration, all of that reflects documented patterns happening at pension funds and endowments globally right now. You can verify this through public data. Pension consulting firms publish research showing over 40% of institutional investors now have Bitcoin exposure. Average allocations are 1% to 2%. Performance data supports income strategies, generating 20+% returns. This isn't speculation. This is documented institutional behavior. And Michael's journey illustrates why Bitcoin adoption became self-reinforcing at institutional level. First, BlackRock provided legitimacy. When the world's largest asset manager launches a Bitcoin product, it signals institutional acceptance. That opened the door for conservative fiduciaries like Michael to even consider allocation. Second, the income strategies solved a real problem. Pension funds need yield. Traditional sources weren't delivering. Bitcoin's volatility, properly harnessed through options, generated substantial income. That's not philosophy, that's portfolio management. Third, peer adoption created momentum. As more institutions allocated, it became harder for those without exposure to justify their absence. Not FOMO, but reasonable concern about underperforming peers who'd found a working solution to shared challenges. Fourth, stress testing validated the approach. November's crash proved that income strategies worked during volatility, not just call markets. That real-world validation convinced skeptics more than any theoretical model could. And fifth, Wall Street built supporting infrastructure. As demand materialized, issuers launched products. BlackRock's January filing was confirmation that income products were now permanent fixtures. Infrastructure begets more infrastructure. This is how assets become institutionalized. Not through revolutionary ideology, through pragmatic problem solving by conservative fiduciaries managing real money for real beneficiaries. Michael wasn't a Bitcoin believer. He was a pension fund CIO who found a tool that helped him generate 7% returns for 93,000 retirees. And the tool happened to involve Bitcoin. But it could have been any asset that solved his income generation problem. That's more powerful than ideology because it's sustainable. Ideology fades, pragmatic solutions persist. The numbers prove it's working. BlackRock's Bitcoin ETF reached $100 billion in assets at peak, $2 trillion in cumulative crypto ETF trading volume, 40+% of institutions now allocated, income products generating 25 to 35% yields, $245 million in annual fees for a single ETF. This isn't speculation. This is institutional infrastructure, built, tested, validated, expanding. And Michael's allocation, 1% of $18 billion, generating meaningful income, surviving volatility, contributing to 7% target returns, represents exactly what's happening across hundreds of pension funds globally. The machine is running. Wall Street figured out how to monetize Bitcoin. Institutions figured out how to use it pragmatically. The infrastructure is permanent now. The rest is just watching adoption accelerate. $100 billion, income strategies generating 35% yields, institutions allocating, infrastructure deepening, BlackRock's highest grossing product in under 2 years. The transformation is complete. Bitcoin isn't an alternative anymore. It's tactical allocation for income generation in institutional portfolios. And that changes everything.